All right, let's get right into it. We're talking Flexsteel Industries today, ticker FLXS, and their latest earnings report. Now, this one's a really interesting story. You've got a company staring down a massive external threat, these new tariffs, but then you look at the actual numbers, and what you see is a story of just incredible execution, plus a few really nice surprises. So let's break it all down. First up, the number that made everybody's head turn. Flexsteel's adjusted earnings per share for the fourth quarter, they came in at $1.40. The analysts on Wall Street, they were expecting 84 cents. That is a 66.7% beat. I mean, come on. A number that big doesn't just happen by accident. It tells you something really, really significant is going on under the hood here.
And the market noticed. Immediately, as soon as these results came out, the stock just took off in pre-market trading, jumping as much as 25%. Investors were basically screaming with their wallets, sending a super clear signal that they loved what they saw, even with those tariff storm clouds gathering on the horizon.
So, the big question is, how did they pull off such a blowout quarter? Let's dig into the numbers that really made Wall Street sit up and pay attention.
Okay, so that massive earnings beat wasn't the whole story. As you can see, they also beat on revenue. But honestly, the really crucial thing here is the consistency. This marks their 7th straight quarter of year-over-year sales growth. That's a powerful trend, especially in what management themselves are calling a choppy market.
Beating expectations is one thing, right? But understanding how they did it, well, that's where the real story is. So let's go behind the numbers and look at the key drivers that really powered this quarter. This is fascinating. You've got this tale of two forces pulling on their profitability. On one side, yeah, the tariffs did create a 40 basis point drag, but that was completely dwarfed by a massive 300 basis point tailwind. We're talking a full 3 percentage points from a strengthening Mexican peso. This foreign exchange benefit was basically an unexpected gift that gave their gross margin a huge boost. And on top of that amazing profitability, the company's balance sheet is an absolute fortress. They ended the quarter with $40 million in cash and, this is so important, 0 debt on the revolving credit line. In a shaky environment where weaker competitors are probably struggling for cash, having this kind of financial firepower is a massive strategic advantage. All right, let's talk about the elephant in the room, the tariffs. Management is not ignoring this threat, not at all. In fact, they have a very clear-eyed view of the risk and a proactive plan to tackle it head-on.
You really can't get any clearer than that. The CEO, Derek Schmidt, said it himself on the earnings call, tariffs are a major risk. So this is not a management team with their heads in the sand. They're setting expectations and showing everyone, hey, we see the threat, and here's how we're going to fight back.
And here's the plan. It's a really smart 3-part approach. First, they're not just going to sit there and eat that 20% Vietnam tariff. They're actively moving their supply chain to other countries. Second, they're hunting for every single cost saving they can find internally. And third, their pricing action is surgical. They've added some modest surcharges, but, and this is the genius part, they simultaneously reduce their old ocean freight surcharges to soften the hit for customers. It's all about defending their margins without killing demand. Just brilliant. But this whole story isn't just about playing defense. No way. Flexsteel is also on the offense, pushing hard to grab market share and expand into new territories. See, they're not just sitting back. They're pushing into the health and wellness space with their ZC liner products. They're launching a huge expansion in case goods, and they're widening their reach through massive channels like Wayfair and Costco. They even mention they're talking with Macy's. This is a company that plans to grow right through all the industry headwinds. So, that's the quarter that was. But as investors, we're always looking forward. We want to know what's next, so it's time for the next call. Let's put on our analyst hat and look ahead. Okay, looking at management's guidance for next quarter, they still see top-line growth, with sales expected to be up 1 to 6%. But you can really see the tariff impact here. Operating margins are guided to be quite a bit lower than the 9% they just posted, and free cash flow is expected to go negative, mostly because of the timing of some annual payments. They're signaling that this fight against tariffs is going to be real. Despite that near-term pressure on margins, our call on Flexsteel is an outperform rating. Why? Well, 3 big reasons. 1, they have a proven track record of excellent execution. 9 straight quarters of operating margin improvement. 2, they have a credible, real plan to deal with tariffs, not just wishful thinking. And 3, that fortress balance sheet gives them the flexibility to outlast weaker rivals in this choppy market. So what's the outrageous but plausible trade idea? Think about this for a second. If Flexsteel can successfully navigate this tariff storm while all their smaller, cash-strapped competitors stumble, they could emerge as a major consolidator, just gobbling up market share. Their financial strength and their operational smarts could make them a very, very attractive acquisition target for a bigger company or a private equity firm in the next 12 to 18 months. It's a long shot, sure, but it's totally grounded in how well they're performing. And of course, we always have to close with the disclaimer. The content in this explainer is for informational purposes only. This is not financial advice.